The most important thing the Federal Reserve did this week was not changing interest rates. It was changing the atmosphere around interest rates. Kevin Warsh's first meeting as Fed chair ended with a unanimous decision to hold the federal funds target range at 3.50% to 3.75%. On paper, that sounds like continuity. No hike, no cut, no dramatic move. But for investors, borrowers, and anyone trying to read the next turn in the economy, the message was more complicated. This Fed is less interested in promising where it is going, more focused on inflation credibility, and more willing to let markets sit with uncertainty. In other words, the pause was not dovish, it was a reset. Let's unpack what changed, what didn't, and why the Warsh Fed may be a very different central bank from the one markets got used to under Jerome Powell. Kevin Warsh officially took office as chair of the Federal Reserve Board on May 22, 2026, after being nominated by President Donald Trump in March and confirmed by the Senate in May. He also became chair of the Federal Open Market Committee, the Fed's rate-setting body. Warsh is not new to the Fed. He served as a governor from 2006 to 2011, through the financial crisis and the early years of post-crisis monetary policy. But now he returns as the person setting the tone, and the tone changed immediately. At the June 16 and 17 meeting, the FOMC voted 12-0 to keep rates unchanged. The official statement said, economic activity is expanding at a solid pace, productivity growth and capital investment are strong, job gains have kept pace with the workforce, and unemployment has changed little. But the key sentence was about inflation. Inflation remains elevated relative to the Fed's 2% goal, partly because of supply shocks including energy. And, in the Fed's words, the committee will deliver price stability. That line matters, because central banking is partly about policy and partly about credibility. A Fed that says inflation is too high is doing one thing. A Fed that says it will deliver price stability is doing something stronger. It is putting its reputation on the line. Now here are the facts. The target range remains 3.50% to 3.75%. The vote was unanimous. The Fed reaffirmed its ample reserves operating framework. The statement was unusually short, roughly 130 words, and it stripped out much of the familiar language investors typically parse for clues. The Fed's June projections showed the median participant expecting the federal funds rate to end 2026 around 3.8%, up from the March projection of 3.4%. That implies that if the data do not cooperate, at least one additional rate hike is very much on the table. FederalReserve.gov. The distribution of the dots tells the story even more clearly. Of the 18 participants submitting projections, 8 saw the year-end rate midpoint at 3.625%, which is basically where policy is now. But 3 saw it at 3.875%, 5 saw it at 4.125%, and 1 saw it at 4.375%. Put simply, 9 officials projected rates above the current range by year-end. That is a split committee, but it is not a committee leaning toward cuts. And Warsh himself did something unusual. He did not submit his own dot. That matters because the dot plot has become one of Wall Street's favorite Fed documents. It is not a promise. It is not a plan. It is a set of individual projections. But investors use it as a map anyway. Under Warsh, that map may become less central. At his press conference, Warsh said the statement was shorter and simpler by design. He said it gave the facts as the committee judged them. He also said forward guidance was not well suited to the current policy moment. And he confirmed that he had refrained from offering projections of his own because of his long-held concerns about the summary of economic projections as currently structured. This is the heart of the Warsh shift. For years, markets have grown accustomed to a Fed that explains itself in great detail. The Fed tells you how it sees the economy, how it sees inflation, how it sees unemployment, how it sees risks, and often how it might react if the data evolve in a particular way. That approach was designed to reduce uncertainty. But it also created a dependency. Markets started trading not just on economic data, but on subtle changes in Fed wording. Warsh appears skeptical of that model. His view, as expressed in the press conference, is that financial markets work best when they react to incoming economic information, not when they spend all their time reflecting the Fed's own words back to the Fed. That is a subtle but important critique. If markets become too focused on central bank guidance, then market prices stop being as useful as signals. The Fed ends up listening to an echo of itself. So the Warsh Fed may talk less. But that does not mean it matters less. In fact, it may matter more, because every shorter statement, every missing dot, Every press conference answer becomes more consequential. Now let's talk about why inflation dominated this meeting. The May Consumer Price Index rose 0.5% for the month and 4.2% from a year earlier. Energy played a major role. The Bureau of Labor Statistics reported that energy prices increased in May, and private analyses of the report highlighted how much of the monthly inflation pressure came from energy-related categories. That creates a difficult problem for the Fed. If inflation is coming from an oil shock or a geopolitical disruption, higher interest rates cannot pump more oil, unclog shipping lanes, or resolve a conflict. But the Fed still has to worry about second-round effects. If households and businesses start to believe that 4% inflation is normal, wage setting, price setting, borrowing, lending, and investment decisions can all adapt to that higher inflation world. That is what central bankers fear. A temporary energy shock is one thing. A shift in inflation psychology is another. Warsh's message was that the Fed will not assume temporary relief in energy prices is the same as durable disinflation. This is important because markets often want to look through commodity shocks. Investors say energy is volatile, core inflation matters more, and the Fed should not overreact. That argument has merit. But after several years of inflation running above target, the Fed has less room to be casual. The interpretation then is this. Warsh is trying to re-anchor the Fed's inflation-fighting credibility early in his tenure. That does not guarantee a hike. It does not mean the Fed will ignore the labor market. It does not mean the Fed wants to cause a recession. But it does mean the burden of proof has shifted. Investors hoping for cuts now need convincing evidence that inflation is moving back toward 2%, not just evidence that growth is slowing at the margin. There is also a political layer. President Trump appointed Warsh after Jerome Powell's 8-year tenure. Trump had repeatedly favored lower rates, and markets had speculated that a Trump-appointed Fed chair might be more open to easing. But Warsh's first meeting did not deliver that. Instead, he joined a unanimous hold and allowed projections to show that nearly half of officials saw higher rates as appropriate by year-end. Trump's public reaction was notably restrained. Reuters reported that when asked about the Fed's decision, Trump said, "It's all right, whatever," and also expressed confidence in Warsh. The significance is not the quote alone. The significance is that Warsh's first major test was a test of Fed independence. A president who wanted lower rates appointed a chair who immediately declined to provide them. For investors, that is important. Fed independence is not an abstract civics lesson. It affects inflation expectations, treasury yields, the dollar, mortgage rates, and risk premiums. If markets believe the Fed will subordinate inflation control to political convenience, long-term rates can rise, even if short-term rates are cut. If markets believe the Fed will defend price stability, that credibility can help contain inflation expectations, though often at the cost of tighter financial conditions in the near term. And financial conditions are where this becomes real. For households, a Fed that is willing to keep rates higher for longer means mortgage affordability remains strained. Credit card rates and auto loans stay expensive. For businesses, debt refinancing costs remain a bigger issue. For markets, higher discount rates pressure equity valuations, especially for companies whose profits are expected far in the future. That is why stocks sold off after the meeting, and why yields moved higher in key parts of the Treasury curve. The rate decision was expected. The communication shift was not. Now, the institutional overhaul may be just as important as the rate path. Warsh announced 5 task forces. 1 on Fed communications, 1 on balance sheet policy, 1 on data sources, 1 on productivity and jobs in an era of transformation, and 1 on inflation frameworks. He said the task forces would start work in the coming weeks, begin producing insights in the fall, and ideally conclude most of their work by year-end. That is a lot for a first meeting. The communications review could reshape how the Fed uses statements, press conferences, minutes, transcripts, and the dot plot. The balance sheet review could affect treasury markets, bank reserves, mortgage-backed securities, and the mechanics of monetary policy transmission. The data review is especially timely because the economy is changing quickly. Artificial intelligence investment, real-time private sector data, changing labor supply, productivity surprises, and volatile energy prices all make traditional indicators harder to interpret. Warsh's argument is that the Fed needs better real-time information. In the press conference, he questioned whether old survey methods and delayed economic releases are enough for policy decisions in a 2026 economy. That is not a small critique. It suggests that the Warsh Fed may be more willing to rethink the machinery of central banking, not just the level of rates. So what happens next? There are three broad scenarios. Scenario 1. Inflation stays sticky. In this case, energy prices remain elevated, services inflation does not cool enough, and inflation expectations begin to look less anchored. If that happens, the hawkish half of the committee gains influence. A quarter-point hike before year-end becomes the base case, and markets have to price a Fed funds range that could move above 3.75%. In this scenario, Treasury yields likely stay firm. Growth stocks remain vulnerable, and credit-sensitive parts of the economy feel more pressure. Scenario 2. Inflation cools, but growth holds up. This is the soft landing scenario. Energy prices ease, core inflation trends lower, productivity remains solid, and unemployment does not rise much. In that world, the Fed can stay on hold and let restrictive policy work gradually. Warsh still talks tough, but the committee does not need to hike. Markets may eventually recover some confidence, but rate cuts would still require patience. The Fed would want to see a trend, not a single good report. Scenario 3. The labor market weakens meaningfully. If job growth slows sharply, unemployment rises, credit conditions tighten, and business investment rolls over, the Fed's dual mandate comes back into balance. Price stability still matters, but maximum employment matters too. In this scenario, the Fed may have to choose between inflation that is still above target and an economy losing momentum. Warsh's quieter communication style could become a challenge here, because markets would be desperate for clarity, just as the Fed is trying to offer fewer promises. The risk across all three scenarios is communication. A quieter Fed can be more flexible. It can avoid boxing itself in. It can force markets to focus on data rather than hints, but it can also increase volatility. If investors do not understand the reaction function, every CPI report, jobs report, oil headline, and Fed speech becomes a potential shock. That is the trade-off Warsh is making. Less hand-holding, more optionality, more emphasis on price stability, more uncertainty for markets. The closing takeaway is this. Kevin Warsh's first Fed meeting did not change interest rates, but it changed the policy regime investors thought they were dealing with. The Fed is still on pause, but it is no longer signaling an easy path toward cuts. It is reviewing how it communicates. It is rethinking its balance sheet and data systems, and it is telling markets, in plain language, that inflation is still too high, and price stability comes first. For investors, the message is not to assume that a hold means relief is coming. Under Warsh, a hold may mean the Fed is waiting for more evidence before deciding whether the next move is up, down, or nowhere at all. And for borrowers, businesses, and markets, that means the age of highly choreographed Fed guidance may be giving way to something more austere. A central bank that says less, tolerates less inflation, and expects everyone else to do more of their own work. As always, this is analysis, not financial advice. But the signal from the first Warsh meeting is clear. Higher for longer is still alive, and the Fed may offer fewer clues before it acts.